Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is heading. This video is going to focus on the SP 500. I'm going to have a look at the ASX 200 as well as copper, gold and uranium in a separate video. I'll leave a link for that in the description section below. I'm also going to tell you about an asset which is getting very close to a key level, so make sure you stick around for that. As always, this is general commentary, doesn't take your personal situation into account. With all that said, let's go to our first chart. So, SP 500 up on the screen, and there has been a lot going on, some really interesting things to look at on this chart. So, I think the big question is, are what we're seeing now, is this a correction to what we've seen previously almost over the last year now? Is it a correction to that big advance, or is it something else? Is it something bigger starting to unfold? So I want to start by just restructuring the way we're looking at this chart. So for quite a while now, I've had these blue horizontal lines on the chart, just outlining this big range the market had been in for such a long time. We saw that break out from that back in June. I'm going to take these off now because they're not the most relevant points for us to be looking at. I'm also going to take off this support zone, which was so important a few months back, earlier in the year, but not so much now. I want to draw some other things which I think are more important to be keeping an eye on. So the first thing I want to do, I'm going to draw in. I'm going to draw in a trend channel, and let me just play around with this for a moment. I've got to just adjust this chart to get the base of the channel right. There we go. That's right. Just making sure I've got these lined up as well as can. Yeah, that actually works quite nicely. So if we look at this trend channel, so this is formed since the October low last year, and it's really only taken shape in the last few months until we had this touch point in late July. There really wasn't a trend channel there. We just had 2 points and we had a point on top, and that's not a trend channel. You need multiple touch points. So now we've got 2 on the top, we've got 2 confirmed on the bottom, and just in the last day we've started to bounce off what could potentially be a third point right here and now. So this is going to be an interesting one to keep an eye on. Is the integrity of the lower end of this channel going to remain intact over the next week or two, or is it going to give way? Now, another thing I want to look at, which is important, is support. I'm going to draw some structural support in on this chart. So I'm just lining it up with my eye as I'm going, and it comes in at around 4,200. So yeah, that's about the mark there. So you can see, so I'm lining up this previous low point from back last year. We've got some technical activity last year in April, another high point. There's done a little bit of work through there. Picks up some previous high points. So yeah, look, around 4,200. Now, you may remember on the way up, 4,200 was a key barrier. It took the market several months to be able to break above it. It was a really strong overhead resistance point. And once resistance breaks, it then becomes support. So we're about to find out whether this is going to be as strong a support as it was resistance on the way up. And so this is going to be really chilling, but quite a bit going on around this 4,200 level. Another thing I've been doing is I've been using Fibonacci retracements. I've been using the May low, using the recent high, and you can see the shaded area. I'm actually going to take these off now because I don't think they're as relevant as they have been. And the reason for that is they were quite useful in August, finding this 50% retracement, getting the bounce. But what I'm thinking now is this correction, is this pullback, it's getting out of proportion to what we saw in the previous period. So there's a bit of I think Fibonacci retracements, there's a bit of an art to them. I don't think they're a precise rules-based indicator. There's a lot of discretion, and when I just look at it now, I just don't feel that doing Fibonacci's off the May high to the July high works so well, given that this is much larger in scale than the previous pullback. So the Fibonacci's are now off for the time being. Now, this could still be your classic zigzag correction, and the zigzag correction is a scenario which I outlined back in, I think it was in mid-August. It was mid-August where I started saying, look, we could see this develop into a zigzag of some description, and that's exactly what we've got at the moment. We've got that classic zigzag, and the second leg lower in the zigzag, it often is sharp and often brings plenty of fear. So that would fit with the type of market sentiment we're currently seeing. And we've got this situation now where we do have this cluster of supports just around current levels. So I think that for the time being, I don't want to buy this dip. Even though we've got these supports coming in, it's not a dip that I want to merge at the moment. I want to buy at the moment. And what I want to do, I want to see if we do get a rebound. We start getting a rebound during the Thursday session. Yet to be seen what happens in Friday. Of course, I'm filming this on Friday afternoon in Sydney, and we don't know what's happened during the Friday session in the US. But at the moment, we are getting some sort of a bounce off this support. So what I want to do, I want to see what this bounce looks like, if indeed that it continues over the next few days. And this could be quite telling, because what I want to see whether do we get a shallow bounce that this just tracks sideways above support. That would be the concern. That would be the red flag, because a shallow bounce often opens a pathway for another test lower, or potentially a break lower. I'd rather see, if this is going to be playing into a more positive scenario, I'd want to see a strong bounce over the next few days to keep those bullish, those more optimistic scenarios in play. So what happens over the next few days, maybe the next week, could be quite important for giving us a bearing on where this is going to be heading. And I think that, and also whilst we're on this, let's just jump over to the weekly chart quickly. And just looking at the weekly chart, where we currently are, here's the 50-week moving average. And you can see that the SP500 is just starting to rebound off that 50-week moving average at the moment. So, as I say, cluster of supports, 50-week moving average, 50-week moving average, trend channel base, and horizontal structural support. So, three things going on. So, I don't want to get caught up in the whirlwind of bearish sentiment, which is currently playing out. But I don't want to jump the gun and say, okay, it's going to base here either. I want to see what this next week brings. Is it shallow and potential break, or is it strong rebound? Let's just wait and see on this and play the price action as it comes. I think that while these supports remain intact, it's a case of, I think, siding with the possibility that this is still corrective. This is a pullback from the July high and not a major reversal. That said, I'm selling stocks that are breaking support and hitting their stops. I'm not holding and hoping for a rebound. I think we need to be disciplined with our exits in these situations where the market is reaching important levels, and if the stocks are giving way, it's a case of getting rid of them. If the market then later rallies and starts looking good, you can get back into stuff. But if markets fall away and you hold stocks on the way down, you don't always get a second chance to sell. So that's how I'd be playing with this at the moment. Watch this 4,200 level. I think it's really, really important. Now, jumping over to one other thing I want to show you, it's the number of SP 500 stocks above their 50-day moving average. You may remember I showed you this back in, I think it was back in July. The point I was making back then, and we went way further back than 2021. We went back into the 20 teens. The point was when the number of stocks get above the 90%, when you have more than 90% of S&P 500 stocks above their 50-day moving average, it's actually a positive thing, and a pullback in the number often just leads to a pause in the trend, a consolidation, as you can see during these periods. Not all the time. Sometimes this is a different situation because it was a rebound within a bearish trend. But more often than not, it's a case of when the number of stocks get above more than 90% of them above their 50-day moving average, a pullback in the indicator is normally a pause in the trend, not a reversal. We're getting pretty close to seeing whether this is a pause in the trend or a reversal on this occasion. But what I want to draw attention to on this time, not so much that storyline I was telling you about previously, but it's more about where things are now. You now see that this indicator has cycled to the lower end of the range, and it's now the opposite plays true when we get to below 20% of stocks above that 50-day moving average, as we are now. It tends to be associated with rebounds in the market. So if I can just compress that up a little bit and just quickly showing you what I mean. We tend to get these rebounds. They don't all turn into lasting bottoms, but they often do. For instance, we can get situations like here, where it did lead to a bounce, but not a lasting low. But more often than not, we find that these tend to be low points in the market. So let's see what happens here. We've got at the stage where the number of stocks above the 50-day moving average is starting to rebound. So that's positive. Usually the trigger for this signal is when they rebound back above 20, break below 20, and then rebound above. That's usually the trigger for some sort of reversal. Let's see whether the market, like as I keep saying, what this rebound, if we get it, what it looks like. It's one of those times where you can get those turning points. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks to the video. It just tells YouTube you're watching, and YouTube shows other people, which helps me heaps. So please do that. Now, let's finish up with just a couple more things. Russell 2000, the small caps. And it's, look, we've got the breakdown below some shorter term support at around 1,800 about a week ago. The last week has just been a shallow consolidation below that, which is what is now resistance. The moving averages are now starting to cross and turn lower. So there are a couple of negative factors to go with this market. We're also in the bottom half of the range. So momentum is currently to the downside. I think it's a case of, just like it is with the SP 500, it's a case of being defensive, being cautious. I think not being in a hurry to buy this dip. I want to see what sort of bounce happens, if a bounce does happen. I think there's still a realistic possibility that this becomes a large basing structure, but we need to see positive price action first. I just don't want to be rushing in going, oh, this is going to be a basing structure, so let's buy, because at the moment, it's a case of fighting momentum. Momentum's to the downside. Let's not fight that. Let's watch and exit stocks as need be and play a defensive game. Last thing I want to look at, US 10-year bond yield. It's continued to increase, and that's been the case since we started looking at the breakout from this flagging pattern back in June. Moving averages have been rising and the yield's been rising, so no terrific surprises there. What I want to talk about today, though, I'm going to jump over to a weekly chart. Let's jump to a weekly, and let me just compress this a bit. And we're approaching a really important level, which is 5%. Now, if I compress this a little bit more, you'll see that this goes back to, well, this point here is 1993. So that's almost, it is 30 years. 30 years, 5% has been a level of significance. And it's also one of those round numbers that people sort of get fixated on. Rapidly closing in on 5%. And really interesting to think about, like, what could happen here. Now, there's not so much a scenario, but it's really just to be aware of what's happening and start thinking about what sort of things could happen as we approach. This isn't about calling a top on this, because trends can extend for a lot further than people believe is possible. You know, for all I know, this shoots through to 7%. I'm not saying that's going to happen, but things happen that people just don't think are possible. So it's not about calling a top. We don't know where that's going to be. We're going to be guided by the price action. But it is interesting when we jump to, I'm going to now go to a monthly chart, get even more data on this. And I'm going to, because all this data back here in the early days is patchy, I'm going to go to a line chart so we can get a bit clearer. And what I'm going to do here, just with some Fibonacci's, just to get some idea of how these things can play out. Now, if we use let's use this base here from 1954, and let's measure up to a intervening high point. And when the market did peak, you can see it pull back to the Fibonacci's. We could even use that point below. And when the market peaked, it pulled back into that Fibonacci region. We can go even higher and pull back into that Fibonacci region. Once we got a peak, the pullback was significant. It was a very significant pullback. Now, let's do this. You can do this on the way down in yield as well. We had a sizable leg down, rebounded into the Fibonacci's. Again, let's do this leg here, down, back to the Fibonacci's, and so on. You can do this the whole way down, and it often works quite well. You get the sell-off and you get the rebound to the Fibonacci's. What could happen here? Let's use the low point, and let's just say, for argument's sake, this resistance proves formidable and rates stop there. Could we get a pullback? What could the pullback look like? And when you put the Fibonacci's on, you see, is it possible that rates peak, yields peak, and then come back towards 3%? Based on everything we've seen over a lot of history. So I was using a point from 1954. And just the way these Fibonacci's work is giving general proportion to the structure of markets, it is possible we do get a peak sometime in maybe the weeks or the next few months, and then a lengthy pullback towards that 3% mark could happen. What would that mean for equities? I don't know. In the past, these pullbacks have led to strength in equities, but we're jumping ahead. It hasn't even happened yet. It's just planting the idea to saying to watch, be aware of 5%, be aware of what could happen around there, and then we can look closer at the strategies for how that could affect equities. So look, let's leave that there for this week. Thank you for joining me. Hopefully that's been interesting. I look forward to coming back and talking to you next week. Till then, bye for now.